Pricing liability, Bank of America and the Epstein settlement. In November 2024, Bank of America reached a $72.5 million class action settlement related to allegations that the bank failed to properly monitor and report suspicious financial activity connected to Jeffrey Epstein's criminal network. This settlement represents one of the most significant financial accountability measures linked to the Epstein case. Bank of America has publicly stated that it denies any wrongdoing and maintains that the settlement was reached solely to avoid the cost and uncertainty of prolonged litigation. The bank emphasized that the resolution does not constitute an admission of liability or acknowledgement of any failures in its compliance systems. However, when we examine this settlement in the broader context of financial industry accountability, a troubling pattern emerges. Between 2013 and 2023, major financial institutions paid over $5 billion in settlements related to similar compliance failures. Yet despite these massive payments, not a single institution admitted to criminal liability. This creates a systemic precedent where financial penalties become simply the cost of doing business, rather than meaningful deterrents to institutional misconduct. The timeline of Bank of America's relationship with Epstein reveals an 11-year compliance gap that raises serious questions. From 2002, when Epstein first pleaded guilty to soliciting prostitution from a minor, until 2013, when he was finally exited as a client, the bank continued its relationship despite multiple red flags. During this period, over 160 victims came forward, and significant suspicious financial activity continued to flow through Bank of America accounts. The Bank Secrecy Act requires financial institutions to file suspicious activity reports, or SARs, when they detect potential criminal activity. The legal mandate is clear. Banks must identify suspicious patterns, investigate immediately, and file reports within 30 days. However, the reality at Bank of America tells a different story. Internal documents suggest that SAR filings were significantly delayed, investigations were inadequate, and the bank continued processing transactions even after identifying red flags. This allowed criminal activity to continue unimpeded for years. One particularly striking example involves a $170 million transfer from billionaire Leon Black through Bank of America accounts to Jeffrey Epstein's trafficking network. This transaction, which occurred between 2012 and 2017, was later classified by the bank's own compliance systems. Yet, according to investigators, Bank of America never adequately questioned the purpose or legitimacy of these transfers during the active period. The scope of the problem extends far beyond Bank of America. The U.S. House Judiciary Committee has identified $1.5 billion in suspicious transactions related to the Epstein network that flowed through multiple major banks. Representative Jim Jordan has specifically questioned why Bank of America and other institutions failed to report these transactions in a timely manner, despite having sophisticated compliance systems designed to detect exactly this type of activity. The Judiciary Committee has issued a subpoena to Bank of America with a deadline of October 22, 2025. The subpoena demands comprehensive documentation including internal communications about Epstein and his associates, all suspicious activity reports filed or drafted, records of compliance decisions and escalations, transaction records for identified suspicious accounts, and documentation of any internal reviews or audits related to the Epstein relationship. The committee's stated goal is to understand how these systemic failures occurred and to prevent similar breakdowns in financial oversight. The financial implications are stark. While Bank of America has paid $72.5 million to settle this specific case, the total unexamined financial activity related to the Epstein network exceeds $1.5 billion. This represents a ratio of $1 acknowledged for every $20 that remains unexamined. The House Judiciary Committee investigation seeks to close this accountability gap and ensure that financial institutions cannot simply pay settlements while avoiding deeper scrutiny of their compliance failures.